Hello everyone, thanks for checking out my video. The Santa Claus rally took a little pause last Friday as major stocks declined. The losses were led by the Magnificent Seven as all of them closed the day in the red territory, with Tesla falling close to 5% and Nvidia dropping around 2%. At one point, the S&P 500 has erased more than $700 billion of market cap. Despite the negative day, all three major indexes were up for the week. However, the latest sell-off has left investors questioning whether the anticipated Santa rally will materialize this year. More importantly, with just 2 trading days remaining in 2024, what might 2025 have in store for the stock market? In this video, we will dive into the market outlook for 2025, so be sure to watch until the end to get the full picture, alright? Okay, the US stock market kicked off the Santa Claus rally period last Tuesday as the S&P 500 clinched its best Christmas Eve performance since 1974. Both S&P 500 and Nasdaq were within striking distance of their record highs, having recovered most of the losses from the Fed-induced sell-off on 18 December. But the Wall Street's holiday mood ended abruptly last Friday, with all three major indexes closing lower in yet another broad-based sell-off, led by the technology sector. Every member of the Magnificent Seven was in the red on that day, pulling down the entire market and placing the Santa Claus rally on pause as we headed into the final trading week of the year. One of the reasons behind the sell-off could be a rise in treasury yields. The yield on the benchmark 10-year treasury rose to 4.63% as it hit its highest level since May this year, amid expectations for a more hawkish Federal Reserve in 2025 and inflation concerns. In case you are not aware, rising yields translate into increased borrowing costs, which can limit companies' spending on innovation and expansion, ultimately putting additional pressure on their profit margins. Anyway, despite Friday's decline, the market is still on track to yet another standout year. The S&P 500 is on its way for a gain of around 25% in 2024. That would mark a second consecutive yearly gain of more than 20%, the first time that has happened since 1997 and 1998. Alright, the final trading days of 2024 are here. With the market closing on New Year, it will be another holiday shortened week, and investors will have just 2 days this week to make their final trades, without major news on the economic data fronts or earnings announcements. I would expect another relatively muted week in terms of trading volume, but just like last week, expect some level of volatility because fewer market participants means a few big orders could easily move the prices significantly. Looking ahead come January 2025, it will be an action-packed month. The next and the first major focus for the stock market will be December employment report due on 10 January. Thereafter, the new earnings season will commence along with Donald Trump taking office on 20th January. On top of that, investors will also turn their attention to the Federal Reserve, whose first interest rate policy decision for 2025 is scheduled to happen on 29 January. Moving over to the technical analysis segment, let's have a look at the broader market SPY. Pay a bit more attention to SPY amid the recent pullback. So as mentioned earlier, there was a bit of profit taking in the market last week, and if this continues this week, there are 3 key support levels to watch. The first one is 591, where the 38.2 Fibonacci level and the 50 moving average converge. I am looking at this level not so much on the Fibonacci level, as I am more focused on the 50 moving average as a support. As I zoom out the chart, for the entire year of 2024, there were only 3 occasions where SPY traded below it. And the maximum time SPY traded below this level was about 2 weeks or so. This shows that this 50 moving average is critical for bulls to protect if we want another great performance in 2025. It also means that if the pullback continues this week and if SPY falls below the 50 moving average, don't panic yet. We should give it about 2 weeks or so to see if it can reclaim the moving average. Below this moving average, pay attention to the next 2 key levels, which are 586 and 581, where the next 2 Fibonacci levels are. If SPY breaches the 61.8 Fibonacci level, then I think we can say there is a change in trend. Otherwise, personally, okay, I'm not saying you should do it, Personally, I will look for opportunities to add shares if SPY goes below the 50 moving average, but I will go in with a small tranche. Two things could happen from here. If SPY reclaims the 50 moving average in 2 weeks just like the previous occasions, great. I would be able to ride the upside with the small amount of money I put in on top of my main portfolio. On the other hand, if SPY turns bearish by not reclaiming the 50 moving average and continues to go below the 61.8 Fibonacci level, I will be excited because I will be able to deploy more cash to buy more stocks. Again, I will do it in tranches. And again, this is not a financial advice to you, I am speaking for myself. In terms of the bullish thesis, quite straightforward. The first hurdle is to reclaim the 23.6 Fibonacci level at 597. In fact, I may stretch it to the psychological level of 600. If SPY can close above 600 this week, then the bullish momentum could resume. The longer it stays above 600, then the higher chance we can hit another all-time high above 607 before the end of January. And it seems like bearish head and shoulder pattern is forming on the chart, with the neckline being the 581 level, which makes this 61.8 Fibonacci level even more important. If this head and shoulder pattern really pan out, it may take at least 2 months, and the move downwards could be huge. We are talking about 560s range. So do stay subscribed to my channel as I continue to provide updates on this pattern into first quarter of 2025. Let's now have a look at Apple's chart. Alright, for Apple, it has been very bullish for the last 2 months, which I know it's quite obvious. I think what we are interested now is the probability of the next movement. Well, 2 indicators to watch out this week. First, it's the RSI, which has a bearish divergence forming. If this plays out, we do have some room for the RSI to go down, which means more room for pullback in the share price. For confirmation, watch the second indicator, MACD. It is on the verge of crossing down. Note, it's on the verge, which means it hasn't. Therefore, for this week, pay attention to it. If it has a bearish cross, then Apple is bearish in the very short term. Short term as in 1 to 2 weeks. Anyway, if the pullback continues, I would expect Apple to at least touch the first Fibonacci retracement level at 250. Because when the pullback continues, you really don't know when it will end, so 250 is the minimum. There are so many levels for potential rebound actually below that 250 level, basically those other Fibonacci levels you see on the screen. The important ones are 239 and 235. The latter, which is 235, is the most critical one as it is near the blue support line that I drew at around 237. This level used to be a strong resistance, which has now turned into a support, which means if it breaks, it's waterfall time. On the other hand, a rebound of any of the Fibonacci levels is bullish. From there, specifically above 250, like I always said, at all-time high or at near all-time high, you will never be able to guess when will the big institutions start to take profits and how much are they taking. What I am trying to say here is, do nothing now for Apple. I will not be adding to my existing position nor chasing it at the moment. But that's just for me, not an advice for you. Reason being, Apple has been on a parabolic run, and if it wants to fall, as you can see, there are so much room to fall. But if it doesn't fall and remains at such high price, you also don't know when will massive profit takes place. Imagine buying it at 250s or 260s range and then Apple pulls back to 230s or 220s range. Basically, the risk-reward ratio for the current share price is just not in our favor. So I might as well let my existing position ride the upside if it continues to go up, as I observe by the side in anticipation for a bigger pullback. Moving over to Tesla. If you are trading Tesla in the upcoming 4 weeks, be extra cautious, because we have 3 key catalysts coming up that could move the share price violently. The very first one is its last quarter's and 2024 full delivery numbers. The figures are expected to be out on or around 2nd January. The other 2 events would be Trump taking office on 20th January and Tesla's earnings, which is estimated to be in late January. Going back to the chart, last week was an eventful week as Tesla rallied 7% on Christmas Eve, but then gave back all its gains by the end of the week. The good news is that Tesla is still above the Fibonacci retracement level of 423. If Tesla can continue to stay above this level and the MACD starts curling back up, I think we have a decent probability to hit another record high, which means above 488. As we enter 490s range, I don't think you want to bet against Tesla on hitting the big 500 mark. In terms of the bearish thesis, you might want to pay attention to this range between 414 to 423. Why this range, you may ask? 423, as mentioned, is the first Fibonacci level. As for 414 or 415, it is the previous all-time high, and Tesla retested it last week as it hit 415. This is a classic retrace to retest the previous all-time high, where the previous resistance became support. It's nice to see Tesla bounce off it, but it is not out of the woods yet, and I would expect Tesla to test this 414 to 423 area this week. If Tesla starts closing below 414, then you might want to be on alert. The next support is the psychological level of 400. I personally think a lot of retail investors step in above 400. So if the big institutions want to use the retail investors as exit liquidity, it can flush really quickly below 400 to 380s range, leaving retail investors backholding the shares in the short term. And then if retail investors start to panic and paper hands, we will be looking at Tesla in the 350s range before you knew it. Anyway, 480s range versus 380s range, both are 50 points away from the current price of 431, which translates to at least 10% movement. Note the word at least. Don't be surprised by the time we hit end January, Tesla is more than 10% away from the current price of 431. Once again, please exercise caution if you are trading Tesla shares in the next 30 days. Moving over to Google's chart. Okay, I'm not sure if I could even call this a bearish mini head and shoulder pattern. Anyway, whichever it is, there seems to be a bit of resistance at this 195 to 196 area. During the 2 days when Google pushed above this area, it only happened during intraday, and by the time the market closed, the price got pushed back down. Therefore, if Google can break free from this 195 to 196 resistance area, it means it is bullish, as it also invalidates this cute little mini head and shoulder pattern. A close above 196 would almost certainly see Google retest the big 200 level again. We might even create another new record high. On the other hand, if Google continues to get rejected by the 195 to 196 resistance area, ignore the first Fibonacci retracement level. It is negligible in my opinion. Just jump straight to 185 to 186 area, where the supposed neckline is, if this is indeed a head and shoulder pattern. If that level breaks and if a head and shoulder pattern really plays out, the movement usually is quite huge, and I would expect Google to see sub 180s again, which means it will likely head towards that big gap between 176 to 181, but whether it will fill the gap entirely, it's anyone's guess. Something noteworthy to highlight is that we have two strong support levels within the gap, and they are 178, which is the critical Fibonacci level, and 176, which is the 50 moving average. One more important thing to pay attention this week, the MACD. If we have a bearish cross and followed by Google breaking below the neckline, it just means very bearish. I wouldn't want to hold on to any long or call trades. Moving over to Meta's chart. Earlier on, you learned about a bearish head and shoulder pattern. Let me share another candlestick pattern that is rarely spotted, and that is inverse cup and handle pattern, which is also bearish. Okay, if you have learned something from my video, please help to tap the like button, okay? Anyway, I need to caveat that this may not look like a textbook version of the inverse cup and handle pattern, and as with all other patterns, you cannot rely on just one pattern or indicator to determine the trend. So, one important level, or rather area to watch out for this week, it is 580 to 586 area. I know it may look like it's a wide range, but if you look at Meta's daily movement, 6 points is actually not a lot in Meta's context. Anyway, this area consists of a few key levels, which are the 50 moving average, the 38.2 Fibonacci level, as well as the neckline for the inverse cup and handle pattern. If this area breaks, I think there is a high chance we can skip looking at 570s range, as I would expect Meta to hit 560s range. At 560s range, watch for the 50% Fibonacci level, the blue channel line, as well as the 100 moving average. If I were to give it a range, it's around 560 to 566, another 6-point range. If this area also gets breached, then we can expect another big movement down, perhaps towards low 550. On the other hand, for Meta to invalidate that mini inverse cup and handle bearish pattern, it needs to of course stay above 605 as long as possible. The longer it stays above it, it means Meta is consolidating, and as a result, invalidates the bearish cup and handle pattern. Okay, but I have to say that consolidation doesn't mean bullish, it just means demand and supply are pretty equal, and usually after a consolidation, it's followed by a big movement. Let's talk about this again if Meta indeed enters a consolidation phase. Jumping over to Microsoft's chart, which looks funny to me, it has been flipping and moving between the bullish and bearish camps for the last 2 to 3 months. Despite that, Microsoft continues to grind higher since it hit its low 400 in early November. As the blue trend line stretches all the way to August 2023, I have decided to remove the line from this video onwards as we zoom in a little bit more to look at the shorter term trend, which is marked by the green dotted line. So as you can see, the near term trend is still bullish, but with the latest pullback, Microsoft is hitting a pivotal area, a point where I might step in to either buy some shares or sell a put option. Let's give this pivotal area a range between 421 to 424. This area consists of the new green uptrend line, the 100 and 200 moving averages, as well as the important 61.8 Fibonacci level. With so many key support levels coming in together, it means this is one very strong support. But there's always a but. Here's something to highlight. Though strong support offers a high probability of a rebound, if the smaller odds of breaking it below plays out, it's pretty bearish. In other words, if I step in here, I will step in small. If it drops further, I will step in more. But if it bounces up, so be it, at least I have dipped my toes in. Anyway, this is not a financial advice for you, okay? Apart from this 421 to 424 area, the other level that's worth watching is the 50% Fibonacci level at around 430. Reason being, if you realize, does it look familiar? Looks like Meta's chart, right? If this is also another bearish inverse cup and handle pattern, then 430 level would be the neckline, which is pretty important in my opinion. Okay, to invalidate all these bearish thesis, very simple, go above 444 and close above it. Last but definitely not the least, let's check out Nvidia. Ever since Nvidia broke below that green dotted uptrend line, it has been stuck in this downtrend channel marked by the 2 red lines. Sorry, I know it's a lot of lines. Let me walk you through the details. Last week, Nvidia tried to break out of the downtrend channel on 3 occasions, but failed to do so. What didn't help is that the price went near to 50% and 61.8 Fibonacci levels. Typically, for the price to reverse a trend, it needs to push through both of these levels. Apparently, Nvidia didn't manage to do it. With these Fibonacci levels and the downtrend channel in place, it makes the technical analysis a bit more straightforward, at least in the near 2 weeks. But before that, a quick one, I recently signed up for a new brokerage account with Longbridge Singapore, so I thought to do a quick sharing here. In case you're not aware, the organization behind this relatively new brokerage firm are backed by leading global tech companies such as Alibaba and ByteDance, which is the parent company of TikTok. So Longbridge app basically works like most of the low-cost brokerage apps out there in the market, and I would say the trading fees are pretty competitive for the US and Hong Kong markets. And oh, in case you wonder, the company behind this brokerage is a licensed entity regulated by the MAS. But just a quick note, and to be honest with everyone, being licensed doesn't mean the investments are risk-free. So always do your own research, alright? And oh, just to add, I actually did a video review of this brokerage firm and app, covering the sign-up process, key features, and my personal experience of using the app. Do feel free to check it out if you have time. Well, if you have stayed throughout this portion, I appreciate your attention. And just so you know, Longbridge currently offers sign-up promotions for new users. Should you be interested to find out more, you can check out the campaign directly or use my referral link in the description box below. Sorry, going back to business, where was I? Oh yeah, straightforward analysis. So, in terms of bullish thesis, we obviously need Nvidia to break above the downtrend channel. By doing so, it is not out of the woods yet. The bulls would want to see two scenarios. The first scenario is a solid breakout with the share price going above and closing above the 50 and 61.8 Fibonacci levels. In short, to close above 143. The second scenario would be get rejected by either of the two levels I mentioned, then retrace to retest the downtrend channel, and then rebound up. So anything outside of these two scenarios, I wouldn't dare to say that Nvidia is bullish. On the other hand, if Nvidia continues to be trapped in this downtrend channel, I am not scaring you, but we could see the share price dropping to 120's range again. I previously shared about this, and Nvidia really hit 120's range. So actually, it's nothing too surprising. Investors should only be worried, at least in the short term, if Nvidia starts falling below that downtrend channel. Okay, maybe some of you might be worried, but not for me, because I would be excited. I would love to see Nvidia below 120 again so that I can accumulate more shares. Okay, let's check out my options trades. So last Friday 27 December, I had 4 cash secure put contracts on Tesla expired. The first one is this put contract that sold on 18 November with a strike price of 270. This trade was a pure momentum play. So what happened on 18 November was that there was a report that mentioned President-elect Donald Trump's team was looking to ease US rules for self-driving vehicles, which will definitely benefit Tesla's robotaxi plan. When the report came out, Tesla's share price gapped up at the opening, very bullish. At that point, I knew Tesla bulls and FOMO investors would keep the bullish momentum going, and I quickly stepped in to sell a put contract, which is a slightly bullish move. True enough, Tesla closed the day with a 5.6% gain, and in the next 1 month, basically from 18 November to 18 December, Tesla rallied from 330's range to 480's range, which was a whopping 44% surge. Though the price dropped a fair bit thereafter, my strike price of 270 was never in danger of getting breached. As a result, the contract expired worthless last Friday and I got to keep the juicy premium of $360 without having to close the position. Next up, I will group the other 3 trades together. They are all cash secure put that I sold on Tesla with short DTE or days to expiration. If you had followed my last 2 weekly videos, you would know that I sold these contracts mainly to earn some side income for the festive season. All of these contracts were sold on different dates in December, but with the same expiration date, which was 27 December, and their strike prices were 355, 350 and 315. Clearly, Tesla did not go close to breaking below 400 at all, let alone touching my strike prices. As all 3 contracts expired worthless last Friday, the total profit that I made out of these 3 trades were close to $300, which is equivalent to about 400 Singapore dollars. Extra money for the festive celebration, not too bad, right? Alright, last Friday's sell-off felt like a bit of profit taking across the board. I mean, we had a stellar year, so we shouldn't be too surprised to see some investors taking profits off the table and rebalancing their portfolios ahead of 2025. As the Santa Claus rally period stretches into the second trading day of the new year, I believe many investors are still hopeful of this traditional and seasonal rally to happen. Personally, I wouldn't pay too much attention to this Santa rally period because that's just 7 trading days in total. In the grand scheme of things, this is probably just a blip. What I will be focusing on is the market outlook for 2025. Okay, in case you think I am going to predict the market performance for the new year, nope, I'm not. Sorry to disappoint because I don't have a crystal ball, but I will share with you what I will be looking out for. In fact, I shared a bit on this in my recent portfolio review video. Please check it out if you haven't, as I reviewed my 2024 stock portfolio performance and my side income through options trading. I have linked the video at the top. Anyway, 2 major things to watch in the coming year. the Federal Reserve monetary policy vis-a-vis inflation, and the implications of Donald Trump 2.0. On the former, the start of a Fed's rate cutting campaign has helped to push the stock market higher towards the end of 2024. However, water can both float a boat and capsize it. In other words, if the Fed starts to slow down their rate cut campaign, and worse still, if they start hiking rate again, the market will definitely not like it. The pace and the path of this whole rate cut campaign boils down to inflation. Even though inflation has come closer to the US Central Bank's target of 2%, the recent data indicates that inflation remains stubbornly above that benchmark, and there are growing worries and concerns about it hitting up again, which will further temper the forecast for more interest rate cuts. Speaking of inflation, it brings us to the second key thing to watch for 2025, and that is Trump 2.0. Trump has mentioned about a few big plans during the presidential election campaign, such as tax reduction, tariffs, and immigration policies. The effects of these policies could be labor shortage and upward pressure of salaries, increase in cost for consumers and businesses, among others. All this could potentially drive inflation up again. Some other things that are noteworthy include geopolitical tensions and the ongoing AI boom. First of all, geopolitical considerations will continue to play a critical role in the global economy. Relations between major economies such as the US and China continue to influence trade policies and market sentiment. And of course, we still have the ongoing wars, which we will never know how else it will be escalated or de-escalate. As for the AI revolution, artificial intelligence and automation will continue to drive growth across many sectors such as technology, healthcare, and industrials. However, with many tech giants reaching elevated and rich valuations, the market may place stronger emphasis on fundamentals, profitability, and sustainable growth. Any slight disappointment or below expectations in a company's earnings and forecast could likely lead to a sell-off in their shares. And because AI is ever evolving, I think from time to time throughout 2025, we can expect emerging players and companies in the AI space, which could present decent opportunities for investors. But that being said, be very careful when investing in such companies. You have to do your due diligence because they could be pure speculations. All in all, 2025 will be a year shaped by technological advancements, shifting economic conditions, and evolving geopolitical dynamics. We can expect the Fed to continue to grapple with stubborn inflation while keeping a close eye on a cooling labor market. Trump 2.0 will be a wildcard as he is well known to be unpredictable. And finally, AI will continue to evolve and change how we live and work. Stock market aside, it is definitely going to be an interesting year ahead. I am looking forward to 2025. How about you? What's your expectation for the new year? Do you think it will be a bullish or bearish year? Do comment bullish or bearish in the comment section below. I want to see how many bulls and bears out there. With that, I have come to the end of this video and I hope to continue to produce more videos in 2025. See you in the next one.